So collaboration, when multiple payments have to be signed throughout the company, or multiple people have to sign a payment, well, then Isabel 6 allow you to streamline the payment initiation and signing process across multiple stakeholders. Integration, more and more companies would like to integrate their financial information with their business application. So that's a third domain where Isabel 6 is very strong now. And the fourth one is well known, it's compliance. We have an audit trail, for example, that allows you to trace everything that any user has done on the system, but also a very secure login system using the Isabel smart card. So that allows me to give the word to our first speaker, Mark-Eli. And if everything goes well, Aurélien, you can share the presentation.
Sure. If you can just open my camera, Patrick, please.
Yes.
Good morning, all. I'm happy to be here. It's a great pleasure to introduce this webinar for Western Union Business Solution. Thank you to Isabel Group and Patrick. Health crisis, COVID crisis, economic slowdown, really navigating through uncertainty is a real challenge for our customers. Today, we will try to provide you with keys to reading, analyzing, and helping you to make the right decision on the global foreign exchange market. The Western Union brand is well known as the world's leading money transfer company in the C2C world, in the B2C world as well. But did you know that the Western Union Business Solutions is the world leader in foreign currency payments for businesses in the B2B environment? Let's have a look on these specificities. We serve more than 60,000 customers around the world, and we are present in 200 countries. We operate in more than 130 currencies. Who are our clients? Small businesses, large corporate, financial institutions, legal, academic, educational institutions in France and Belgium as well, and NGOs. We help all our clients in two main areas: international payment with incoming, outgoing, and mass payments, and risk management through our dealing rooms. We advise, we help, we monitor all our clients' position in the market in order to always make the right decision in the market. Let me introduce George. George Vessey is our senior analyst, but just before that, you can easily find our capabilities into your preferred Isabel 6 platform. In the payment environment, you can click on find best rates, and then you will just find the Western Union logo. You can click on add service in order to get the best rates and best service in the market. You just will go on this information form only for the first connection, and then you will benefit all our best services into your traditional Isabel 6 platform. Thank you very much. George, the floor is yours.
Thank you, Mark-Eli, and a warm welcome to everyone this morning. Thank you for joining. So as the FX and macro strategist at Western Union, delivering this information over in the UK. Hope everyone is well this morning. Today I'm going to be running through the global economic outlook, taking a look at the expected growth trends, monetary policy and inflation outlook as well, and then a deeper dive into the US, the Eurozone, the UK economies, and a brief look at China before then we go on to the all-important FX volatility and FX forecasts. So if we move on, the macro outlook, let's kick off with that first, the global overview and the recovery prospects. As we know, back in the end of November, December, there was the time when we saw or hopes of a brighter future, and this all stemmed from the vaccine progress, which unravelled numerous success stories coming out from Pfizer, AstraZeneca, Moderna, etc., and that prompted a rotation of capital into some pro-cyclical assets on the expectations of a faster economic recovery. The good news is most of the economic fabric has been preserved globally and could quickly be revived, but the situation is obviously very precarious still and remains vulnerable for lots of people, lots of firms out there, and lots of countries. Of course, we've got the emergence of multiple variants, more contagious variants of COVID that could still derail the global recovery situation, especially given the rise in daily cases that we've seen, particularly across Europe. Thankfully, it has come down slightly, but as you can see, the second and third waves on the top chart, they're are really identifying how fragile this recovery process is going to be if we do see a new wave of more contagious variants overtaking the pace of the vaccine rollouts. The reaction across financial markets has been a positive one, though, of course, in response to the vaccinations, because it does mean that once people are vaccinated, governments will likely ease those physical distancing restrictions, economies then reopen, and this should hopefully kick activity into gear once again and trigger a flurry of activity, consumption, hopefully business investment, but predominantly all eyes are on this consumer consumption, because economies are largely depending on this consumer-led recovery, really, especially with household savings near record highs in a lot of advanced economies. So we see this, or hope to see this pent-up demand really accelerated growth in the later part of this year. What is interesting from a currency perspective is the shift in demand for currencies, whereby the nation or the economy is expected to recover quickly, and of course the success of a vaccine rollout will greatly influence this. So ultimately the market is saying where there's going to be a relative growth rate differential, there's going to be because of the vaccination differential over the next few months. And that's why we've actually seen the British pound, for example, perform strongly, particularly against the US dollar, but also the US dollar fighting back a little bit against other currencies, because the US vaccination rollout is up there with some of the best in the G10 markets, especially, but lagging behind is Europe and Japan for the time being. But just how quickly will the expected return to pre-pandemic levels be? Well, we've got this chart here from the IMF, and that's showing the growth forecasts for this year, or how they've changed. And as we know, the strength of the recovery is projected to vary significantly across different countries. But what's interesting from this chart is the upwardly revised growth forecast for the world and for the US. So you can see at the bottom there, the yellow and grey bars, and this reflects the expectations of a vaccine-powered recovery later on in the year, and also the policy support or the expected much more policy support from large economies, namely being the US, prime example here with the Biden administration trying to push through that $1.9 trillion relief package. And I'll be discussing that in the US outlook in more detail shortly. But ultimately, more stimulus, more multilateral cooperation is one reason why we're seeing this, or why we've seen this growth outlook in the US upgraded. But in contrast to this upgrade, as I mentioned, the European countries and the UK have actually seen their growth outlook downgraded by the IMF. So a bit more surprising perhaps from the UK, given the fast vaccine rollout, but from European countries, perhaps not so much, given so far we've seen the implementation of the vaccine programme dwindle in a lot of European countries, and we've seen the supply of those vaccines disrupted as well, and also a slower uptake just due to prevailing anti-vax sentiment across some European countries. So that's delaying any meaningful economic recovery to take place at the moment. But as I said, on the other hand, the UK has also had its growth outlook downgraded as well, and this comes despite the positive vaccine rollout that's taken place in the UK. So the reason for this is probably due to firstly, the high infection and death rates that were hitting new record daily highs at the beginning of this year, but also there are, of course, cause for concern related to Brexit uncertainties as well. But again, we'll go into that a bit later on in the UK section. Altogether, though, we can appreciate that the outlook remains very uncertain, but hopefully we'll experience a period of stability beyond this, in line with a lot of baseline forecasts out there, which point towards a rebound in economic growth in the second half of this year, and for volatility across financial markets and including the currency markets to recede. If we go on to the next slide, we're just looking at how the pandemic has impacted different industries here. So as we know, it's triggered a broad and rapid disruption across economies, business operations, technology, and infrastructure worldwide. And regardless of the size of a sector, business leaders across the globe have had to respond to this great lockdown that we've seen and on an unprecedented scale, whilst having to deal with the day-to-day roles, levels of sales, uncertainty, currency volatility, of course. So evidently it's been a really challenging environment. But fast forwarding on a little bit into the future here, we just want to look at 2025 growth forecasts for the Belgium economy specifically. So, and it's by sector, as you'll notice, some synergies at the top there between some of those top sectors for growth. So you've got IT, pharmaceuticals, telecommunications, financial services, all expected to grow much faster than the wider economy over the next 5 years or so. And then down the bottom there, you can see that extraction, iron and steel production, even textiles and clothing sectors are expected to underperform. The lower half really is characterized by industries such as industrial manufacturing, production and textiles, materials and metal goods. In general, as you can see, there is a structural shift away from this basic production into the services sector. Moving on to the policy response to this crisis and the expected economic impact this should have. As we all know, there's been an unprecedented monetary and fiscal stimulus around the globe to help support economies through this pandemic, to sort of soften the blow to their respective economies. And we've seen central banks initiate a coordinated easing cycle, so cutting benchmark interest rates. I think there was around 200 rate cuts last year, which was a record amount of rate cuts that's ever been experienced. And some of those rate cuts were down to zero, some deeper into negative territories, we know, in Europe. And we've seen record liquidity as well injected into markets as well. But compared to previous crises, the impact of these conventional measures are somewhat limited because of the magnitude of the recession that we have seen, and already the environment is already sort of an ultra low policy rate, with interest rates already low prior to this crisis. So if we consider the fact that there was a more than 2-year-long trade war going on, particularly driven by the US and China, we had European political hurdles with a Brexit saga, a slowing growth in China as well. This wore down policymakers over the past few years. Thus, the scope for further rate cuts and the margin of error was very slim. And against this backdrop, more and more central banks were leaning towards purchasing government bonds instead of rate cuts in the wake of and in the wake of this increased money supply, we're seeing inflationary pressures start to build even more so. So with central banks expected to remain accommodative, they're still pumping money into economies, then we expect that inflation pressures to potentially build, and therefore the next change in policy to be monetary tightening, i.e. raising interest rates at some point in the future. But that probably won't happen for a few years, especially until we see prices drive higher, i.e. inflation picks up. And there is already evidence of this. We always caution against reading too much into the latest inflation figures, but January's rising core inflation in the Eurozone from 0.2% to 1.4% is certainly eye-catching, and seemingly adds weight to this view that the pandemic could ultimately prove inflationary. But contributing to this rise in inflation will be the rally in oil prices. So that chart on your right there showing how oil prices have been on a volatile journey, but they've scored a rapid recovery over the past 12 months or so. It's actually that oil actually ended its or extended its rally for a 9th day straight yesterday, and its longest winning daily streak in over 2 years. And it's not only as a result of supply cuts that's boosting the price, but also a boost in demand that we're seeing because of this economic recovery and the expected boost in demand for the latter half of this year. We've also seen shipping container costs soar as well, and that's contributed to the inflationary factor. And we'll discuss more on that a little later on. But right now, the focus is on the next economic cycle, the recovery phase, this bullish outlook and an optimistic outlook rather, which is being reflected in the rising oil prices and also in inflation expectations in the US, and also by this rise in government bond yields. So that's why on this chart as well you can see that the US 10-year Treasury yields have risen to their highest level since 2020. And most central banks, though, are going out their way to assure markets that there won't be a shift in policy in the near future to deter this inflation or higher yields. The Fed, for example, just last week said that they would keep economic pillars in place until there's a full rebound in the US recession. And again, we saw Jerome Powell reiterate these comments yesterday. So although we expect to see inflation continue rising, but perhaps US Treasuries rising as well, we don't expect the central bank to actually intervene until later down the line. So this leads us nicely into the US slide. As I mentioned at the start, there's going to be this, or there is this disconnect between Wall Street and Main Street. As you can see from the chart on the left there, that shows US consumer confidence and the US stock index usually have a strong positive correlation with one another. But as I've circled there, since last year, the performance of the stock index has rebounded significantly, whereas consumer confidence has deteriorated, with the loss of jobs, wavering job security, the lack of business investment, and general recessionary factors hindering confidence. So what some might seem, or what some might suggest, is an irrational rise in stock prices could be argued instead as a rational one, because we're in a low interest rate environment, as we spoke about on the last slide, and with inflation expected to pick up, this will lead to negative real interest rates, which will obviously fuel demand for higher yielding assets, but these obviously are more risky assets like stocks. So in other words, the current valuation of US equities can be justified in the context of negative real interest rates. So viewed in this way, the real question is not so much whether or not there's a systemic bubble in risky assets, but whether real rates are going to remain at ultra low levels, which is going to be supportive for this environment. And as I mentioned on the previous slide, with the Federal Reserve expected to keep rates lower for longer, we can expect this trend to potentially continue. And with the Biden administration pushing through huge fiscal stimulus as well as the monetary stimulus we're seeing from Fed, then again, this is going to drive more demand for those risky assets, or at least we're unlikely to see a collapse in the price of risky assets, because this is where investment is going to be going. So a combination of this economic recovery that's expected and continued policy accommodation, whether that be monetary and fiscal, is really going to drive the price of most risky assets over the course of the year. And interestingly, that could weigh on the strength of the US dollar due to its negative correlation with stock prices over the past 12 months or so. But we have seen signs of this trend fading somewhat recently, and it's related to the dollar smile theory. We've actually spoke about this on the last webinar, and the dollar smile theory is that the US currency tends to increase in value against other currencies when the US economy is performing extremely weak or extremely poor relative to the world. Or extremely strong relative to the world, sorry. So if the US economy is just a little bit above or below the world growth rates and the rest of the world is underperforming, then we often see that the dollar actually gains in value significantly. And therefore there's growing signs that the US economy is going to stage a rapid rebound in comparison to other G10 nations, as we saw on the IMF slide. And therefore there's some signs that the US dollar might benefit because of this. So that's an interesting point to bear in mind. But the reason why this is important is that there's growing importance, therefore, on economic fundamentals. And that's one reason why the dollar reacted so negatively to the mixed jobs report that we witnessed last Friday, which is why we've got the chart on the right there just showing the scale of the pandemic's impact on the US jobs market. As you can see, 10 years of jobs creation was just wiped out in just 2 months. And we have seen an impressive rebound, but as per the jobs report on Friday, this recovery seems to be slowing, and therefore perhaps it's questionable as to whether the US recovery will be as rapid as what is thought. And we saw the US dollar retrace because of that. Moving on to the next slide, we're looking at the Eurozone here and the outlook as a whole and what this could mean for the Euro. Well, it's been a really turbulent 12 months, particularly in Europe since the start of the pandemic. But the unity of the EU agreeing that recovery fund last year certainly gave the Euro area a bit more confidence boost. And the euro a big boost in demand as well, despite the dismal number of COVID cases and deaths that we were seeing across the continent. And the market reaction to the massive stimulus measures, not just by the ECB, but by the EU and also globally as well, resulted in economic conditions improving and certainly expectations for a rebound also soaring, which has helped the more risk correlated euro currency compared to the US dollar. The chart on the left there just shows the rebound in economic data after toppling to a floor back in the mid-2020. And since that recovery in expected data surprising to the upside there, we've seen the euro recover in line with it against the US dollar. And it all comes back round to increased global risk appetite as well. When global risk appetite increases, we often see the demand for the euro increase, particularly against the US dollar. But as I mentioned earlier, the baseline forecast for Europe and a lot of European countries and the Eurozone as a whole has been downgraded by the IMF, but not just the IMF. We've got other major economists and institutions like the OECD, the World Bank, and even our partners at Oxford Economics as well, who cautioned recently that no meaningful or sustained advancement in activity is going to be realized until the pandemic situation really improves. And this depends obviously, crucially, on reducing the high infection rates and vaccinating large parts of the population. But progress on both of these fronts has been relatively slow so far in Europe. And as you can see on the chart on the right there, you can see that although the lockdowns at present aren't quite as stringent, the measures aren't quite as stringent as they were back in March, they appear to be on an upward trajectory. And this is to do with trying to contain those infection rates. So in which case to allow the economy to reopen quicker. But of course, increasing these restrictions for the time being doesn't bode well for a speedy recovery in the near term. And of course, a lot of the focus now remains on the pace of the vaccinations, which is picking up. So there's a glimmer of hope there. But as long as that vaccination pace continues to outperform the infection rates and the death rates, then that should provide a backdrop to a brighter future. But it is very uncertain, as I'm sure we can all appreciate. And there are, of course, many downside risks to baseline forecasts. Perhaps there's too much expectation of a rapid rebound so quickly, or stability to unravel in the latter half of this year. The obvious risk is the recurring cycles of accelerating viral spreads, tightening restrictions until the wider or the widespread immunity is achieved. But also there's political risks as well looming with the German elections this year, and there's increased tensions between the US and China, and also the UK and the EU with regards to Brexit as well, which is going to be an underlying risk to the economic rebound, but also the strength of the euro. So if we move on to the next slide, we're having a closer look at the UK here and Brexit. And the main message here is that even before Brexit, even before the referendum back in 2016, the UK's concentration in trade had been diversifying away from the EU, even so far back as the 1990s. And back then, over 60% of the UK's goods exports went to the EU, but that's fallen to around 46%. Where it lies today, and that's expected to decrease significantly due to the UK having left the EU. So this decoupling trend is expected to accelerate. However, on the flip side, there is a potential trend or increased trend of regionalisation here that could become the more dominant factor over the coming years. And highlights the fact that it's going to be difficult for the UK to ignore such an important trading partner that's on its doorstep, like the EU. But one key takeaway from Brexit is that although there's a positive, although there's a negative viewpoint of this decoupling trade with the EU, there is also a positive perspective, particularly from the UK anyway, that there's an opportunity that lies within the services trade. I wanted to draw on this as it is more of a positive twist on the Brexit scenario, as we saw in the expectations of growth, the value-added growth forecast side of Belgium's sector earlier on. Trade in business and financial services is expected to grow, not just in Belgium, not just in Europe, but globally, and to grow significantly globally in the future. And the UK is generally viewed as a world leader in many services activities. So this does bode well for a potentially bright future for the UK economy. And although the EU's single market is the most integrated area for trade and services across the world, we do anticipate that there's going to be brighter spots or opportunities outside the EU which offer a lot of potential, such as Japan or South Korea, for example. But this is more of a long-term view of the UK economy. For now, there are, of course, ample challenges. The fact that there isn't a trade deal on financial services with the EU at present, that hasn't been agreed, and that's posing worries to market participants. We're also seeing certain trade disruptions exacerbated by Brexit come to light over the past few months as well. Food being, one of those industries worst hit by not just or worse hit by the post-Brexit trade deal because of the products being held up due to the red tape and additional paperwork as well. So we've got all these non-tariff barriers, if you like, that are certainly impacting trade flows. And we've already had those trade flows significantly impacted by other uncertainties, other worries, including the soaring shipping costs that I mentioned earlier as well. And as per that chart on the right there, we've seen that bringing goods via containers from the east of the world over to Europe, those costs have risen 3- or 4-fold. And then there's reports of 3/4 of cargoes from France to UK returning empty on top of this freight rate rise, and that's amounted to some serious trade flow concerns building in the UK, which is a big concern. But despite all of this uncertainty in the UK at the moment, the current successful vaccine rollout, or the rapid vaccine rollout in relation to other G10 markets, is certainly providing a positive backdrop for the UK economy. And that's probably why we're seeing the pound appreciate as it has done significantly over the past couple of months or so, particularly against the US dollar, but also against the euro, where we're up at highs not seen since last April. Moving on to the next slide. So briefly talking about China. So there's obviously a lot of talk around supply chain diversification being key here to mitigate the risk of having to depend solely on one provider of particular goods or importing goods or materials from a place like China, especially when a crisis like this exposes the risks involved with doing so. When China shut down in March, April last year to suppress the virus, that ripple effect across the whole of the world, particularly felt in Europe in the automotive industry, was a real eye-opener to that kind of exposure just to relying on one sole provider of particular goods. And therefore this expectation of supply chain diversification to mitigate those risks has certainly come to the fore. But rather than taking all of that on, it seems the case that China actually presents more of an opportunity. It's boasting a slew of opportunities out there at the moment, and that's because of its high growth potential. It's always had high growth potential, but now it's really taken off. China didn't actually experience a contraction last year in economic growth, and for the next few years, it's anticipated that the rebounding growth is going to accelerate. So you've got this combined with reforms from the government to open further financial markets to foreign investors, and we should see more capital drive into the Chinese economy, and therefore we'll likely see the Chinese yuan increase in value as well. It's already strengthened due to China's leading the recovery cycle, but it could go even higher if China was to lead the monetary tightening cycle as well, if its economy does start to boom. And we see that taper tantrum of QE, and we possibly see interest rate hikes from China. So the recovery story for China, it looks like a bright one, and we could see the Chinese yuan benefit off the back of this as well. So finally, currency volatility, of course, one of the most important points of trading internationally. So we're moving on to this next slide. We're looking at the 2021 currency-specific scenarios that have been constructed with the guidance of Reuters FX polls that we've used in this instance. And these FX polls from Reuters come from a number of different contributors. So several forecasters providing their views on where future exchange rates might be. We've got a maximum and minimum expectation along with the median forecast as well. But I would say just before moving on that these aren't predictions, or I wouldn't use these as predictions per se, but I'd use them as a guidance on different FX scenarios to help your business plan for the future. So I think we can all agree that there are always a range of factors that are driving currency markets. You've got global trade, economic data, confidence, monetary policy, politics, seasonal trends, even technical indicators, and then you've got black swan events like this pandemic. There's plenty of factors that need to be considered, which can cause particular capital rotation into particular currencies and therefore driving up valuations of particular currencies. But the crucial point on this slide is to just gauge how or why an exchange rate could rally or could crash as depicted by these scenarios. And if it did trend in one of those ways, whether that be favorable or unfavorable for your business, is your business ready to manage that FX risk or that FX opportunity that will arise here? So I'll start off explaining what this chart is actually showing us here. So on the left-hand side, well, overall, this is a data or chart of the data of the euro to US dollar exchange rate, and the channel on the left-hand side represents the price range over a monthly period, and the yellow cross is the median exchange rate on that month. And you can see that the average monthly price range was about 4% last year. And as we know, due to the weaker US dollar that we've experienced over the past 12 months or so, we've seen the euro climb significantly higher, actually reached a fresh 34-month high at the beginning of this year. Now it's retraced somewhat, but the uptrend certainly seems to be still intact. Now going forward, those forecasts that I mentioned, I've highlighted there on the right, the upper scenario, the lower scenario, and then the base case scenario running through the middle. I mean, the whole, again, reiterating the point that the range may look wide, but history does suggest or does tell us that markets can move erratically and vastly, and it can happen, and it does happen. But in this instance, the market consensus is that the euro will keep outperforming the US dollar this year. But investors have been consistently positioned short the US dollar. So this actually elevates the risk of the US dollar strengthening. And if it did strengthen, then we'll see a rapid turnaround and potentially a quick unwind of this uplift that we've seen over the past 12 months. So what could actually cause this to happen? Potentially the vaccine rollout in the US is a lot more successful than what we see in Europe. And we also see this US exceptionalism, i.e. the growth rate in the US expand a lot quicker. As I mentioned at the beginning, the dollar smile theory, suggesting that the demand for the US dollar because of that is going to increase rapidly. And that could potentially unwind all of those dollar short positions, and we could see that rate slipping back towards that 115 level. So that's a downside risk for this currency pair. If we move on to the final slide, the same concept here, but for the euro against the pound. And as I mentioned earlier, with sterling on the uplift against multiple currencies, partly due to the removal of the Brexit risk premium that we've witnessed, but also the vaccination differential and subsequent growth differential for the UK, which is benefiting the pound against multiple currencies, and which is why we've seen the euro against the pound a drop, as it has done, around 5% over the past few months. And this downtrend could gather speed if this divergence between the vaccination rollout and the growth differential starts to widen, and the UK economy reopens sooner, and therefore economic activity starts to boom quicker in the UK, and we see demand for the pound increase. But we can't discount the dismal economic growth that we did see in the UK last year, and the amount that it's got to make up to rise back to, or the amount of time it's going to take for the UK economy to rise back to pre-pandemic levels. And we also can't discount the risk of new variants emerging as well, and putting a halt to that vaccination rollout, disrupting the reopening of the economy. And when we've seen this kind of thing happen, the pound, because it's more of a risk correlated currency, we often see that the pound will depreciate. And therefore, if this were to happen, the euro would likely benefit compared to the pound, and we could perhaps see the 0.9 mark on this currency pair come back into play. In summary, though, just to repeat, the range is wide on this currency pair as well. The future very uncertain, but in essence, it's all about having an FX strategy in place. And when it comes to that strategy, the important thing to do is stress test it as well. Does it protect your budget rate efficiently? Is it flexible enough to take advantage of any favorable currency moves if it did move in your favor? And is it robust enough to weather any unfavorable moves in this very unpredictable market? But that's the macro market overview from myself finished. Now time for some questions. I'll hand back to Patrick then. Thank you.
Thank you. I will change screens again. And here we are. Okay. Wait a minute, just a second. My PowerPoint has disappeared, but that's okay. I received a few questions, and maybe George, you can address them, or Markeli. The first question is, how would the politics of Joe Biden impact the rate of the US dollar?
Yeah, thanks for the question. A very topical one, of course, with Biden now in power, and the policies very different to what Donald Trump was outlaying. I think in reality, it really depends on the impact on the US economy. So as we mentioned towards the beginning of the webinar, this whole dollar US exceptionalism when it comes to how it's going to impact the US dollar. So there are forecasts that the US economy is going to recover a lot quicker, and that's in relation to or helped by this big fiscal stimulus package that's been put forward. Hopefully we'll have more sight of that. Probably be watered down to some extent, but it's going to be still be a big boost to the economic outlook in the US. But what is this going to mean for the wider economy, for US stock markets as well? I think predominantly we've seen that US stock markets have cheered the news of these more liberal policy stances from the Biden administration. And over the past 12 months, we've seen a negative correlation with US stocks and the US dollar. So in relation to that, we could see that the US dollar depreciates. But the interesting point of view here is that if we do see this US fiscal stimulus start to benefit the US economic recovery, and that US economic recovery gains speed in comparison to other recoveries in the wider G10 space, then for that reason, then we could see the US dollar actually gain ground against a lot of currencies. And there's evidence of that over the past couple of weeks, especially with the US Treasury yield starting to increase as well. If we do see markets start to price in interest rate hikes, even years down the line, that will be a move that's quicker than other central banks, and therefore we could see demand for the US dollar pick up and it benefit the US dollar in the long run.
Thanks a lot, George. I have another question that maybe for Tom or for George also. How does the rates that are proposed in Isabel 6 by the Western Union rates, let's say, differ from the FX rates that are by default proposed by Isabel itself? So actually, is it true that the customer, maybe Tom has an answer for that the customer has two options?
Well, in fact, in Isabel 6, the rates that are shown are only indicative, and they are shown when you are taken by the European Central Bank. So these are only indicative rates. Whereas as soon as you have, if you're a customer of a Western Union Business Solution, you really see the real-time live rates in your Isabel 6 application.
Okay, thanks a lot. We have another question. Do you expect, and that will be again for George, I think, or for Mark-Eli, do you expect that new variants of COVID might cause extra turbulence on the markets?
Yeah, I'll take that again. It's another great question as we're seeing these new variants pop up, and of course it's going to, or potentially hinder the vaccine rollout. If the vaccines aren't as effective as what they first thought with these new variants. But in terms of the impact on financial markets, we've already seen evidence of these new variants potentially negatively impacting vaccines, and the impact on the financial market so far has been relatively muted. And I think one of the main reasons for this is the expectations that eventually we are going to get to where we want to be. We will defeat COVID eventually, and there's a lot of optimism still in the air regarding that. It might be delayed, but eventually we'll get where we need to be. And the other thing that's helping prop up market optimism is this continued financial support, the fiscal support from governments worldwide, the monetary support from central banks, at historic levels. We've never seen anything like it when it comes to supporting economies through a crisis. And one of the main drivers of the market turbulence we saw in the middle of last year was to do with the squeeze in US dollar liquidity. So there was a funding issue of US dollars, and that had knock-on effects across financial markets. And now that we've seen central banks take care of that issue, we've seen the rollout of swap lines across other central banks, USD liquidity is now rife and has certainly soothed the market conditions. So I can't imagine there being a real turbulence, even if we do see new variants to sort of disrupt the vaccine rollout. And I'd like to be optimistic that the market stability is what we need to look forward to for the remainder of the year.
Okay, thanks a lot, George. Yeah, we're now past 50 minutes, so I think I see no more questions. Maybe just one chat here. Let me see. Will Germany lose its dominant position when Angela Merkel is gone? Or will France take over the role of Germany? That's interesting.
Will Germany lose its dominance? It's an interesting one. My political knowledge on who's gonna dominate is probably it's not as good as perhaps one of you guys could step in here. But from my understanding, obviously the removal of Merkel or Merkel leaving is a potential worry to the European political landscape, in terms of, because she was such an avid supporter of that multilateralism and the unity that comes with Merkel, then perhaps dependent on who comes in after the German elections, we will see France overtaken in that respect. But I don't want to step on any toes. In fact, probably one of you guys would be able to answer that question better.
Okay. Thanks a lot. So this allows me to conclude. Just some practical information. You will receive an email, of course, with the presentation itself, or a recording of the presentation. That might be tomorrow or might be early next week. We need to prepare it, of course, but you will be sure you will receive this email, so you can share with colleagues or review it yourself if you couldn't attend. And in name of Western Union and Isabel Group, I would like to thank you very much for attending this webinar, and hoping to see you back very soon on a Isabel Group webinar. And thank you. Bye.